Hey guys, welcome to The Market is Open. Visit our website, themarketisopen.com. In this video, we're going to start with Whitney Tilson, a big Tesla short seller. He lost a big bet with Andrew Left, another short seller, a few days ago after Tesla reported a pretty big profit. But I think this video will actually be very important to Tesla shareholders because although this guy is basically totally wrong and beaten down, basically finished, he still makes some comments about Tesla's accounting and how he thinks there's problems there. So we're going to analyze and answer his concerns, and I think if you're a Tesla bull, you want to see the opposite side's thesis, so let's have a look at his bearish remarks. But before we do, please subscribe to our YouTube channel. We would really appreciate your support in helping us grow our channel. Also, remember to hit the bell button to receive alerts and notifications. And if you want to support us further, please check out our Patreon at patreon.com/themarketisopen, and you could also check us out on Twitter at themarketisopen. Okay, so Whitney Tilson is a hedge fund manager. He used to manage about $50 million at a company called Case Capital Management. However, he has been a giant Tesla bear for a very long time. He actually started shorting Tesla shares at around $35 a share, thinking that they would go bankrupt. That's pretty much at the beginning of this chart. Now, he thought that Tesla would run out of money, but they didn't. Instead, shortly after, Tesla stock shot up and he had to cover at $205 a share. That's almost 5.8 times the value of where he started shorting at. So when you're short, you're betting against the stock and your losses could be infinite, which is the opposite of when you buy a stock and it goes bankrupt. At least it stops at zero. So shorting, you can go negative, and that's what happened to him. So he lost about $5 million off of Tesla, and it likely contributed to him needing to shut down his hedge fund. So he calls it the worst short ever. You almost feel bad for him. However, he didn't stop there. In an interview in April of 2018, he was saying that he was telling all of his short seller friends not to short Tesla because it's a fake stock and people will buy the product no matter what, and it's a cult stock, which I think is a pretty dumb term. I mean, even Apple was a cult stock at one point. You can argue that it still is a cult stock, but who cares? If people are buying the product no matter what and the company has fans beyond belief, then that's a great business strategy. Anyways, you'd think he'd learn his lesson after this, but no, in February of 2019, he was back on the short side. He was saying, now is the time I think the story cracks about Tesla. He also thinks that they pulled forward demand for Model 3. That was at the time in 2018, at the end of the year, when some of the tax incentives for Tesla were running out. And he compares Tesla to Wile E. Coyote when Wile sort of jumps off a cliff, but he's sort of in midair and his legs are running underneath him and he's about to fall. So that's how he was saying where Tesla was. He said every indication says there isn't any demand for Model 3. And he set his price target at $100 for the end of 2019, which is actually coming up pretty soon. So Tesla stock was actually at the high 200s at the time. It ended up going down a little less to 180 earlier this year, and right now it's back at the 300 levels. He also thanks Tesla for bringing electric cars to humanity, so he seems to be very impressed by what Tesla has done. But he still says that they're only a tiny fraction the size of the giant competitors, and the competition is coming. And I mean, now, even about 8 months later, competition is of course still coming. Anyways, around that time, earlier this year, he had bet Andrew Left, who's another short seller. He was actually short Tesla stock at one point, but then changed his mind and was right just before a quarter. Actually, Andrew Left has actually made pretty good calls on his trades with Tesla. But the bet was that Tesla wouldn't have any profitable quarters in 2019. So he lost the bet when Tesla reported a pretty big profit on October 23rd. They earned 80 cents of GAAP earnings per share, which we covered extensively on our main channel, The Market is Open. So with this bet, he lost $15,000. It was a charity bet, however, and apparently he also made bets with a dozen other people as well. So he admitted being wrong, but he's still a major skeptic of Tesla stock. And I think it's great that there are skeptics. It's always good to have skeptics in the stock. I think that's very important. But Tilson has been dead wrong about everything related to Tesla. His track record is horrendous. And if you did the exact opposite of what he said, you'd be up enormously. So he's also spreading a good amount of negativity about the company. He says, there's no question that reporting a positive net income, operating cash flow, and free cash flow quarter is impressive and unexpected. And he says the stock responded accordingly, thanks in part, no doubt, to the mother of all short squeezes. But then he throws in that the numbers that Tesla reported don't make any sense at all. So here are two of the main things that he has problems with. Number one, he says that the sales of Tesla exceeded production, but inventory went up by $200 million. So actually, Tesla's Tesla's production was 96 million cars. That's what they produced, but they sold 97 million. So they must have had to sell cars that were in transit or in inventory or somewhere before. Yet inventory went up. So how is that possible? He doesn't understand how that could possibly have happened. The second thing is that sequential revenue was down. So the revenue going from last quarter to this quarter was actually down. However, pre-tax profit, rose by 546 million. So we're going to explain these two things. But Tilson does go on to say that there are some funny things going on here, and Tesla didn't provide much in any way of explanation in their earnings update, and he puts updating quotes in their conference call. So first of all, the 10Q wasn't actually out at this point, so he just had to wait a couple days to read the 10Q. But he's saying, to be clear, I don't think there was outright fraud, so he's already using the word fraud. Rather, I suspect the company did the classic kitchen sink accounting in the first half of the year, whereby they take massive write-downs and then they sort of release that excess to make the third quarter numbers look pretty good. That doesn't seem to be the case, actually. There weren't gigantic write-downs that Tesla had earlier in the year or anything like that. He also says something like, believe it or not, done correctly, all of this is within the bounds of GAAP accounting, hence it's not technically fraud, although it's certainly misleading. So he's hinting that Tesla is doing a lot of weird stuff, and he uses the word fraud a whole bunch of times. But I actually think he is completely wrong with everything he's saying, and we're going to show you that right now. Okay, so we'll take these one by one. I'll start by saying that, yeah, he has no idea what the heck he's talking about. Okay, so sales, so production numbers were lower than deliveries. Here we have production at 96,000 vehicles approximately. Deliveries 97,000, but inventory was up 200 million. How is that possible? There's also a Seeking Alpha article which mentions these concerns. To be honest, actually, this article seems to complicate things even further. Here's the quote from the Seeking Alpha article, which tries to, or which also brings up this concern. It says that Tesla has not published its finished goods inventory for September 30th, 2019 yet. Exactly. So why are we debating this? But we know total inventory went up by 200 million despite having delivered about 1,000 cars more than produced. It might be possible to explain the $200 million increase from a reversal of inventory impairments in the second quarter. Without a doubt, the 10Q will give us more information. So I think this seems to go in line with what Tilson is saying about the kitchen sink thing, meaning that they took big write-downs and then replaced the inventory with new inventory that was worth more. This theory actually, to me, doesn't make that much sense, since it implies that a chunk of Tesla's vehicles are worth significantly less than other versions of their vehicles, which doesn't actually make that much sense, or that the cost of them is very little to produce these vehicles, and then they sold some at higher prices or something like that. That doesn't make a lot of sense either. We know Tesla's margins are about 20 to 30%, even for Model S and X. And the new Raven versions that Tesla released are not valued much higher than the old versions. So yeah, the problem is that they're jumping to conclusions even before looking at the 10Q, and they're spreading FUD around some of the made-up theories that they had. Josh looked at this and he was immediately like, what the heck are these idiots talking about? So first of all, the $200 million is not a lot when you're talking about Tesla's $6 billion of revenue in the quarter. It's just not a lot for this size company. Secondly, inventory has very little to do with the number of cars that were delivered versus produced. So this thing, how they're trying to relate deliveries and production to inventory is completely wrong. You shouldn't even be relating these two things. They didn't consider a whole bunch of things, which we're showing here. This is actually from the 10Q report. So it looks like they didn't consider materials, work in progress, or service parts at all. They only looked at finished goods. Also, parts of this are not just from vehicles, they're from the solar business as well. Tesla actually does explain this in the 10Q a little bit further, but I won't go into that right now. The only part that was related to deliveries and production was finished goods, and that was flat. Of course, this is from September 2019 to December 2018, and that's a $400 million gain. But these guys are talking quarter over quarter, which is 200 million. So it is part of these numbers. So basically, if Tesla builds a motor and that motor isn't part of a car, it's considered inventory. So that explains the gain in inventory. Perhaps they took an extra part of a car and they shipped it to a service center just to have spare parts, sort of in the warehouse or in the service center. That would count as inventory. Or if they started building a car and they didn't complete the car, that would also count as inventory. So you can see all of these other line items went up, except for the finished goods, which is what the Seeking Alpha attributed to. That actually stayed flat. So this explains the gain in inventory. Okay, Tilson's second point is that revenue was down, but pre-tax profit rose 546 million. Okay, so for this, I'm going to refer to my spreadsheet. I just copied Tesla's quarterly income, and it's available for free on Patreon, patreon.com/themarketisopen. Okay, so this question is basically, how is it that Tesla's revenue was down, yet the profit was up? Okay, so revenue was down about 46 million from the previous quarter. So then now let's look at expenses. The biggest drops came from the cost of actually producing cars. So there's about 200 million right there. And that's only less than 5% of the $4 billion base. So it's actually not that much. Although these numbers sound big, it's not a lot of money for a company that's making billions and billions of dollars. Also, service and energy on lines 22 and 23 here were down. So they cut a few $1,000,000 from that and saved quite a bit on service. I should also note that the service revenue itself also went down, and Tesla reported $30 million of deferred revenue, which is like pure profit because it's software related, so it has very high margins. And they're also going to continue to do that for at least the next year going forward. So yes, the margins will be slightly inflated, and they were a little bit by just 30 million in this current quarter. For the future, it will spread out over many quarters due to the Smart Summon release, but also due to further full self-driving releases that Tesla is going to be doing. They also cut out another $50 million from SG&A on line 28, and they simply didn't have restructuring this quarter on line 29. So there you go. That's how they turn a giant profit. Clearly, Tilson didn't seem to look at the income statement. But looking ahead, however, like how sustainable is this for Tesla's business going forward? I actually think that all the things we talked about are fairly sustainable. You could say, well, okay, they have a restructuring charge and then they won't be profitable. But that's usually supposed to be a one-time thing. I still think Tesla can cut out more costs from the business, especially in SG&A, since the car ordering is actually all done online. And I think a lot of this can be automated, and Tesla does seem to be working on that, which is why SG&A continues to, I guess, basically break records for Tesla, and it goes down each quarter despite their number of deliveries going up each quarter. All that said, the lower cost sets them up very well to be quite profitable again, especially when the China Gigafactory starts contributing to revenue. So if Tesla's revenue rises and their costs stay flat or even go down if they continue cutting costs, then Tesla will actually be even more profitable going forward. All right, guys, thank you so much for watching. Hopefully you enjoyed this video. Please let me know if you have any questions or comments. Leave them down below. This is our new TMIO stock channel. So far, we're talking mainly about Tesla. If you subscribe to the channel, we'd be really appreciative of that. Also, smash that like button and share this video with your friends. Thanks so much for watching.